If you have recently decided to sell your accounting practice, you may have encountered the AICPA's 90-day notice requirement as it relates to the transfer of your client records. If that's the case, you're probably wondering something that I get asked almost every day, which is, how is everyone else complying with this? If you're not familiar, the rule specifically talks about accountants and their client records in the context of the sale of a business. So if you're selling your business, it might not be top of mind. You just want to get a buyer. Once you do get a buyer, you're confronted with having to transfer those client records after closing. And then you might have learned from somebody somewhere about the AICPA 90-day notice requirement, which says it doesn't matter if you sell your business, it doesn't matter if it's a stock sale or an asset sale. If you sell your business, you still have to get the client's consent before you can transfer the client records to the buyer. Or you can provide this notice and consent, and after 90 days has elapsed, the consent can be presumed and you can transfer those client records. That can be really problematic. That's 90 days where your buyer is paying for the overhead of a business, they're dwindling working capital, and they're supposed to be working on these client files that maybe they don't even have access to yet. So how are people complying? I'm Sara Sharp. I'm a deal attorney who helps people buy and sell accounting practices. And I'm not going to give you legal advice. And I'm not going to tell you whether something is compliant or legal or not. I am specifically making this video to answer the question, what is everyone else doing? So I see a lot of deals. I see a lot of brokers and bankers and deal makers in this space. And I talk to them and I ask them, what are you seeing? So these are not necessarily accounts from my client base, but these are some of the solutions that I have seen implemented, and you can make decisions for yourself. Sometimes people say, all right, well, all of my client records are located on a server, and I'm going to keep that server as an excluded asset in this asset purchase. After closing, once you have gotten consent or 90 days has passed, you can have the server. In the meantime, you're welcome to license the server's information from me. Now, I'm not going to weigh in on my view of the compliance there, but that is a solution that I've seen a couple times. Another solution I have seen is, oh, okay, so this only applies if this is an external buyout. Well, I like this buyer, fine. I'm going to make him or her a partner the week before closing, and then it's going to be an internal transfer. So I don't have to jump through these hoops. Generally speaking, the time of year when people take a more aggressive approach here tends to be in tax season, where the 90 days would really cripple their clients if the buyer was not able to work on the client records. So keep that in mind. If you have the 90 days, strict compliance is a great option. And if you have a small client list, a lot of folks will say, hey seller, you want me to comply with this, I want to transition the business. How about you do me a solid and you give every single one of the clients a call and make sure you chase down these consents as soon as possible. And in the meantime, talk very highly about the new guy or girl who's running your business. That's a great solution. If you have, less than 100 clients in particular. If you have 900 or several thousand clients, that's not terribly realistic. Another thing that comes up in the whole chase down compliance category is, okay, well, do you have an email relationship with your client base? A lot of firms are still paper-based. And so if you're still paper-based, you may not have an email, or if you do, you might not have an email relationship with your clients where they're looking out for an email and actually thinking that they need to respond to it. And that makes chasing down written consent a lot harder and takes a lot longer. So that's a question to ask if you're a buyer of a company really upfront. It's like, how do you want to handle this? And do you have that email relationship? Another thing that I see that I think is a nice solution is people will say, okay, well, I'm the seller. I'm going to sell my practice. You're not going to get any of the client records until we get consent. But, to the extent that you need access to them, I'm also going to keep my LLC open and retain you as a contractor. And under that umbrella, in my old business, with you as a contractor for $1 or something, I'm going to be permitted under the rules to allow you access to those client records in that capacity. And that can be a nice stopgap the parties seem to feel. Personally, I would love to see a change to these rules to make it something that's not going to hinder the seller and the buyer so much. I think what we're trying to do is noble. I think that the rule is attempting to protect client records and probably, address the roll-ups and the radical acquisition that's happening. This is very sensitive information, but the notice requirement written the way it it is, it can be very burdensome to try to comply with, especially leading up to a tax season. That's the question I'm answering with this video.